Hey guys, how's it going? Lewis Hardigan here and welcome back to my channel, and in today's video I'm going to be analysing Unilever's stock using fundamental analysis and then using a DCF valuation model to come up with a fair value of their stock. Let's get straight into it. So who are Unilever? So Unilever plc is a British multinational consumer goods company headquartered in London. So they produce all sorts of products including food, condiments, ice cream, amongst many other things. They are the largest producer of soap in the world and their products are available in around 190 countries. So yeah, a hell of a lot going on with Unilever. They own over 400 brands and their turnover in 2020 was 51 billion euros, so they are a very, very big company, and their market cap as of today is 105 billion pounds, so one of the biggest companies in the FTSE 100. They have all sorts of brands. 13 brands with sales over 1 billion euros, Lynx, Dove, Persil, Hellmann's, Magnum, all sorts of stuff. So yeah, they have a lot of brands and a lot of products they're selling worldwide. But they are split into three main segments, so food and refreshment, home care, and then beauty and personal care. They have development facilities all over the world, in China, India, Netherlands and the UK, and obviously the US as well. They were founded in 1929, so they are quite an old company. They were formed after a merger between a Dutch company and a UK company to form Unilever. They've also had a lot of acquisitions in the past. You can see the list below: Dollar Shave Club, Ben & Jerry's, they're probably the biggest names there. And they have a primary listing on the London Stock Exchange, and they are probably one of the biggest constituents of the FTSE 100 index. Now let's have a look at the sales breakdown for Unilever, and the beauty and personal care has 42% of the sales, food and refreshment has 38%, then home care comes in last with 21%. So the first two segments are pretty evenly split, which is something I do like to see. Multiple segments making up the revenue. All the revenue isn't coming from one place, so that's also a good sign to see. Sales per region, so the Asia and Africa and the other countries in that list make up 36%. The US 19%, Europe 17%, and then the others. So pretty evenly split between around the world really. There's not one continent making up most of the sales. So also another good thing, they are a truly global company selling worldwide, which is a really, really good thing. Now let's have a look at the income statement, and let's be honest, the sales are very stagnant. This is a pretty low growth company. They are stalwart, as Peter Lynch would say, but what's important, the net income. They're making consistent profits and they have done for many, many decades. The net margins are consistently like 10% plus, so that's a good thing. And yeah, what else can I say apart from it's a slow growth company, but they're making decent net income. So pretty simple really. Now let's have a look at the balance sheet extract for Unilever, and first figure I look at is the net debt. So this isn't really decreasing that much, it's very stagnant. In 2019 it increased a lot, and then in 2020 it's come back down again, so who knows where this is going. You'd like to see it going down as much as possible. Consumer goods companies do often have more debt than other types of businesses, but still not a good thing as a shareholder. It is a bit of a red flag and something to keep an eye on. Free cash flow has been growing the past few years. It's probably going to be stagnant, to be honest, going forward. It'll probably grow in line with revenue. Return on equity though is very, very solid. Lovely numbers to see there. 40% plus. You can't go wrong with that, so that's a tick in terms of return on equity. Now let's have a look at my analysis checklist, and just to let you all know, I will be updating this spreadsheet going forward, and I will have a new system. I will still have the 4 pillars, but they're going to be updated, and I will have a Lewis score, which will ultimately determine if I think the stock's a buy or not. But yeah, let's have a look at Unilever. So pillar 1, it's all about profitability, so they're pretty profitable. Margins over 10% and very, very high returns on equity, which is good. But the major red flag with Unilever is the amount of debt they've got. The long-term debt to equity is over 50%, which is a figure I do not like to see, and it can be an ultimating factor for me when buying a stock. Then the current ratio is not above 1 as well, so not good. It seems like we've got a bit much debt on the balance sheet, which is never good in my opinion. And then looking at pillar 3, yeah, it's a bit all over the place really. Revenue hasn't been growing, it's pretty stagnant. I'd say free cash flow growth and profit growth, you'd think it would be similar, but it's just up and down all over the place. But it's still quite strong, strong figures really. And then over the years, return earnings growth has been there as well. And then decrease in share count, dividend growth, previous acquisitions, all yes. Solid acquisitions, Ben & Jerry's, Hellmann's, etc. All pretty good. But then pillar 4, buy at a fair price. Unfortunately, the PE ratio on price to free cash flow is above 20, which is not good. But then the DCF calculation for a 10% return shows £43. So we'll get onto that. And it's interesting how the DCF doesn't match up with the PE ratio or price of free cash flow as it usually does in most scenarios. So let's have a look at that and see how I got to that figure. Now let's have a look at the DCF valuation model, and for a 10% return I'm looking at a share price of £43 for Unilever. So this is what I've done. I've taken the cash flows going into the future, discounted them at 10%, then bingo, I've got my share price. So what I've done with the cash flows is I'm increasing them. I think I put it at about 3% per year, alongside economic growth. So yeah, £43 for Unilever, 10% return, probably matching / beating the market at that price. So still pretty interesting for a lot of people's portfolios. So what are my thoughts on Unilever? And to be totally honest, I'm not all that impressed really. After looking over the figures again and doing some more analysis, from doing this video, it's just made me realise how much debt the company has, and it's a really, really, really big red flag. It's not good. It's not good at all. The long-term debt to equity is very high for a business of this size, and it's just not a good sign. And if things go wrong for the business and they can't meet the debts, it's not good for us investors. So not really happy with it, and I do own Unilever myself in my portfolio, and I'm currently reviewing my position because I'm not entirely happy. I'm a bit indifferent, and I feel like I've made a bit of a mistake really by owning Unilever, and I'm currently looking for different options. So I'm looking at Nestle, I'm looking at Procter & Gamble. They're the two main businesses I'm looking at. I'll probably go with Nestle, and I might do a video on that, so stay tuned. But yeah, I think Unilever, they've got a few problems. If they can't grow alongside the economy, for investors it's just going to stay very flat and stagnant, and it probably won't match the market. So that's always a big danger, and alongside that big debt load, it's probably not a good sign. So yeah, even though I own the company, I'm still reviewing my position, and we will see how it goes, but I'm currently looking at other options, and we'll just see, won't we? As investors, I think it takes a lot for us to admit our mistakes, and I think with Unilever I might have made one, even though it's a very popular stock. Amongst dividend investors in particular, as a dividend of like 3 or 4%. So I know in the UK it's a very popular stock, but I'm just looking at it and I'm not entirely happy with what I see. The high debt load and the low growth going forward, it really, really does concern me. And if I was paying a multiple of 10, a PE ratio of 10, so the stock was like in half right now, I'd maybe be all over it because you'd be getting a really good deal for the amount of cash flows you're getting in earnings. But I'm not entirely happy, so I think I might have made a bit of a mistake. I'll review it, I will let you all know of course, and we'll go from there. But what do you think of Unilever? Let me know in the comments. Do you own Unilever? Let me know your bull and bear thesis. I like to know all different scenarios, so I'd be really interested to know your thoughts in the comments. As always, thank you very much for watching today's video, and you should not take this as financial advice and take it all with a pinch of salt. Do not listen to what idiots like me say on the internet. It's all for entertainment and educational purposes only. If you want to learn more about investing and join my community, why don't you join my Patreon? This is a jam-packed, full of action, and you get direct access to me, detailed analysis on stocks, private Discord, amongst many other things. So yeah, for a £5 a month you get all of that, so top stuff. So yeah, thank you very much for watching today's video, and if you haven't already, please leave a like and a comment, and subscribe to the channel if you haven't already. Thank you very much for watching. I will see you next time. Thank you for watching. As always, it would be amazing if you could like, comment and subscribe to the channel if you enjoyed this video. I will see you in the next one. However, you can check out some of these videos